All right. Are you an investor or trader? Now, this is where you're going to make your decision. Do you want to receive a recurring income for a long period of time, or do you want to make cash? You need cash. If you need cash, then you are a trader. Now, investors don't really worry about the share price, okay? Take this as an example. If you've got a guy who owns a whole bunch of flats, okay? He's not worried about the value of that complex. What he's concerned about is the rental income that he receives on a monthly basis and how much he's going to raise it next year, okay? Forget about the tenants, all right? That's an investor's approach, okay? A trader wants the cash. He wants to buy something now, sell it at a profit in the shortest period of time. So investors are not concerned about the share price, and they will only be concerned about the dividends that the company will pay. So remember, in your large caps, you get very little growth, but you get high dividend yield, okay? So it's a good way, it would be a good idea to diversify yourself a bit. And the way investors manage their risk in the market is by diversification, okay? When I mean diversification, I don't mean in long-term instruments and then short-term instruments. I mean spreading their risk in the market, looking at different funds. Like, for example, you could take a certain percentage and allocate it to equity, a certain percentage and allocate it to exchange-traded funds. Remember, they are a basket of companies that are pre-selected, on which you still receive dividends whenever the companies pay their dividends, but your risk is pretty much spread out quite nicely. So you could have equity, exchange-traded funds, and a whole lot of number of other long-term instruments to spread your risk. And always remember that when we find something good, we tend to buy a lot of it, okay? But if the market turns, we don't want to lose all of our money. So we don't go and risk all of our money in one particular share sector. All right? You can only buy, or should only buy, one share per sector. Shouldn't have about five. Go for the banking sector. Banking sector is doing well. Go buy Standard Bank, Absa, Capitec, Nedbank, Rand Merchant Bank, the whole lot, okay? Market turns and all your money's gone, okay? That's ill advice. And also, being an investor, you may be limited for time, okay? You may be 60 already, you may be 50, okay? You've only got 10 years until you retire. Time is an issue. You can't afford to lose your money, because what about, you won't be able to create that income, all right? So you need to be very, very careful about your strategy. And then also your general interest. Where's your interest? Do you like the adrenaline, the excitement of a short-term instrument? Okay? Get that little heart beating fast? Okay? Or would you like a more relaxed approach? So investors manage their risk by diversification, and 10 well-chosen shares can actually be managed with less risk than one. Okay? And that, what's his name? I think it's Warren Buffett. Not Warren Buffett, can't remember the guy's name now. He basically says, diversification for those who don't know what they're doing. That's fine, because most of the time nobody knows what they're doing in the market anyway. Okay? So we will diversify. The trader. Like I said, the trader wants to make cash. He or she is going to be sitting in front of the computer on a weekly basis or on a daily basis. And traders manage their risk with stop-loss orders, coming back to your question. You can never trade, or should never trade, the market without a stop-loss order. Okay? If you are thinking of doing that, then you are doomed. There's 3 key elements to become a successful trader. And the first one I want to go into is the method. Okay? The method. Obviously, I'm sure some of you, most of you have been to Monte Cassino. Now, Monte Cassino is a gambling place, and a lot of people will associate the market as a gambling place too. All right? But who's more risky, the investor or the trader? If the trader's got a strategy, and he or she is buying and selling at certain points in time, and the investor's just buying and holding a share forever, who's actually the gambler? Depends which angle you're looking at it. Okay? But Monte Cassino is not in the gambling business. There's actually no ambiguity in gambling whatsoever. When you go to that casino, you're going to go with your 500 Rand or 1,000 Rand, and you have already decided that this is what you're going to lose. And you're thinking about all these wonderful things that maybe you'll come back with 1,000,000 Rand or 500,000 or whatever the case is, okay? But what is the chances of that happening? Not going to happen. So it's entertainment, right? The market's also entertainment, but with a strategy and a method, okay, we can probably put the odds in our favor. And when you go to Monte Cassino has the game of positive expectancy. You have a game of negative expectancy, which means that for every 1 Rand you put in the machine, Monte Cassino is taking 10 cents. Their objective or their business is to keep the bums in the seats, and they will do anything in their power to keep you there. And I don't think that I'm sure that you've figured this out already, but the longer you stay, the poorer you get at Monte Cassino. Isn't that so? Okay? So now, we as traders sit down and think, there must be an easier way. Okay? There must be an easier way. Why can't we change the game around and give us the benefit of having a positive expectancy game? And that is what we are going to do. That is what your strategy in trading will do. It will give you that positive expectancy game. So the method must make you more when you're right than what you lose when you are wrong. Because if you are wrong, I'm sure most of you would rather be dead than be wrong, right? Okay? So we've got to be right. And when we're right, we want to be making as much money as possible. Because we're going to be wrong. We need to accept that. Now, obviously, looking at the money part is the risk to reward ratio. Okay? And how we do that is protect your capital by means of a stop loss. Now, obviously, if you're going to be placing money in the market, okay, you're going to place a bet. I'm sure they can see it up there. If I'm going to play a game with you, and if you're right, you're going to bet 10 Rand, okay? And if you're right, I'm going to give you 20 Rand. But if you're wrong, you're only going to lose 10 Rand. Will you play that game? Will you play that game? Okay? Because that is a game of positive expectancy. So every time you flip the coin, the market's going to go up or down. Who's got a universal trend detection device, like a 5 Rand coin? Who's got a 5 Rand coin? You got a 5 Rand coin?
I have a 5 Rand coin.
Yeah. Can I have it?
Yep. How much are you going to give me back for it?
I'm going to give it back to you. That's tails, right?
If you say so.
Okay, that's heads. Right. Okay, patience. Is the market going up or down today? Which way? You say up. Okay, so up is heads or tails? Heads. Tails. Okay, you lose. So that means I get 10 rand. Okay? Right? Flip the coin again. Where's the market going, Victor? That is? Heads or tails? Because that's as much as a calculated guess you're going to get. Heads or tails?
Tails.
Tails. That's tails, eh? That's tails. Heads. You're wrong. Okay. So, that's basically what it's like trading the market. Thank you very much. Okay? You've got a 50-50 chance. Right? How much money are you going to bet when you're wrong? You don't know. You need to place your bet first. Okay? And then take a chance and see where it goes. But if you're right, you're going to make double your money. Okay? And if you're wrong, you're only going to lose what your initial risk was. And that's the game that we are here today to offer you.